Welcome to Capital Link's company presentation series.
Good day to everybody. I am Nicholas Bornozis, President of Capital Link. I would like to welcome you to the 2026 Capital Link company presentation series. In this series, company management highlights the company's current operations, business development, growth prospects, and sector outlook. We are privileged to have today the senior management of Seanergy Maritime Holdings Corp, Mr. Stamatis Tsantanis, Chairman and CEO, and Mr. Stavros Gyftakis, Chief Financial Officer. Seanergy Maritime Holdings Corp provides marine dry bulk transportation services through a modern fleet of Cape-sized vessels. The company owns or leases 20 vessels with an average age of approximately 14.7 years and an aggregate cargo carrying capacity of approximately 3.6 million deadweight tons. The company's common shares trade on the NASDAQ capital market under the symbol SHIP, SHIP. Now, in terms of logistics, we will begin with a company presentation followed by a live Q&A. Please note that participants can submit their questions anytime during the webinar through the Q&A button on your screen. Your questions will be answered during the Q&A session after the presentation. Now, before we begin our webinar, just the usual disclaimer. Please note that this discussion is strictly for informational and educational purposes and should not be relied upon, and the webinar obviously does not constitute an offer to buy or sell securities or investment advice or advice of any kind, and Capital Link bears no responsibility for it. And we are privileged to work with Seanergy on investor relations. Now, let us begin our discussion. I'd like to pass the floor to Mr. Tsantanis to take us through, and then Stavros to take us through the company presentation.
Good morning, everybody. Nicholas, thank you very much for having us. It's a great pleasure, a great honor to be once again at the series of Capital Link. If we can move to the next slide number 3, please. Thank you very much. A few words about the company. Seanergy Maritime Holdings is a prominent, multi-awarded, pure-play Cape-sized shipping company. We are listed on the NASDAQ capital markets, and our ticker is SHIP, SHIP. Currently, we own and operate a fleet of 20 ships, 18 Cape-sizes and 2 Newcastlemaxes. As I mentioned before, we are a pure-play Cape-size and Newcastlemax company, and we will be discussing about that further down in this presentation a lot. Currently, our deadweight ton total transportation capacity is 3.6 million, but with the addition of our new buildings, this is going to grow by another million deadweight tons in the next few years. So it's going to be around 4.5, 4.6 million deadweight tons in the next few years. Right now, we have invested over $425 million in order to produce one of the industry's lowest book value per deadweight, which means that we have bought our ships on a deadweight basis cheaper than most of our competitors. We have a highly experienced management team, more than 100 years of aggregate experience in the shipping industry, us on the board, solid corporate governance. There's no associated companies whatsoever doing business with the company, so it's a fully consolidated entity. We have long-standing relationships with some of the world's largest charterers, vessel operators, freight operators. So we are considered to be one of the most prominent names in the Cape-sized transportation of dry raw materials. And as a very strong differentiating factor, we are an independent company, which means that we don't have any family ownerships. We don't have any sponsored ownership by any private equity funds or anything like that. So we believe that the interests of the management team and the shareholders are fully aligned. Moving on to the next slide, please. A few words about the evolution of the company since 2015. It's 11, 12 years now getting to the evolution of the company since we relaunched our operations in 2015. Back in the day, we started with just one Cape-sized vessel. So from the beginning, we knew that this is the sector that we wanted to be investing in. We saw the fundamentals and we saw what the prospects of this market of the larger bulker size meant for the market. So over the course of the next few years, we grew from one Cape-size vessel into 20 Capes and Newcastlemax vessels today. Just a few highlights of 2022 and afterwards. We have distributed, as we will explain further down, approximately $51.2 million in cash dividends. That's about $2.64 per share. We have completed 21 million convertible notes. We have grown our fleet into this 3.6 million tons I mentioned before, plus the new buildings now. We have cleaned up our capital structure significantly, and we have done in the last 5 years approximately $500 million of new financings and refinancings. And of course, we have right now a fleet expansion and renewal plan, which is approximately $380 million. Also in 2022, we spun out the United Maritime Corporation, what we believe to be a very strong benefit for our shareholders. We do not include in the distribution of the $2.64 per share the dividend that we paid on United Maritime, which we estimated to be anywhere around $1 altogether. So that's excluded. That gives you an idea of what kind of successful transactions we have done. Also, the company has not done any dilutive offering since 2021, February 2021, where we did our final equity capital raise at a significant premium to our net asset value at the time. Moving on to the next slide, please. As I mentioned before, we are a pure play Cape-size platform. As you can see from the fleet list on the right-hand side, we have a very, very homogeneous fleet. The majority of our vessels have been built in Japan and South Korea. We believe that our ships have been built in some of the world's most well-known shipyards in the world. Our current average age is approximately 14.7 years, which is fine for now in the next few years, but we also have started a $380 million fleet renewal program, under which we will start delivering ships as early as 2027. I must say here that we have 3 vessel deliveries, new vessel deliveries in about a year's time from now, and that shows the capability and the capacity of this management team to find very recent and very prompt new building delivery slots in order to provide immediate cash flow generation for our shareholders as early as 2027. Moving on to the next slide, please. A few words about ourselves. I'm with the company for almost 15 years now. Stavros joined, and sitting next to me, Stavros joined approximately 8 years ago. And we have 3 independent board members, and they have more than 100 aggregate years of shipping and finance experience. Most of the board members have been with the company for many years, even before I joined the company, and they are very world-renowned personalities in shipping and the financial markets. Moving on to the next slide, please. A few words about our ESG. We are a multi-awarded company as far as ESG is concerned. I know that ESG is not so much the flavor of the day, given the current conditions and the geopolitics happening, but still we are very much invested in, most importantly, in making our ships more and more efficient. We have invested millions of dollars together with our charterers in making the ships more fuel efficient and to reduce the emissions. And when I say reduce the emissions, that's actually saving money for the company because, as you know, we have a lot of fuel taxes, especially in Europe, such as Fuel EU and EU ETS. So the more we invest, the better off is the company, not only in respect of the environment, but also in obtaining better returns on its investment by reducing our carbon footprint. A lot of awards and distinctions about our social and our governance. We believe that we are one of the best governed company in the US capital markets in shipping altogether, and that has been evident with the awards that we have received. Most importantly, what we must say here is that we are the first and only Greek-based shipping company to have participated with the European Union in an EU-funded, fully funded, a project called Safecraft, which is right here on the right-hand side of this slide, which is the retrofit of a 2012 built vessel for sub-generator and hydrogen propulsion, and that is happening as we speak now in China. So it's a material project for us that started 3 years ago, and we expect to deliver that ship with a very nice ceremony at the end of the month. So that's a great achievement for us. Also, we are one of the very few, if not the only, Greek shipping company that has been receiving awards for best workplace year after year after year, which is a world-renowned organization as far as the work environment is concerned. So moving to the next slide. Slide number 9, please. Thank you very much. What we must say here is that this is pretty much the strategic direction of the company, the mission statement, to put it this way. First of all, the company has grown by about 80%, as you can see here, since 2020, and we have managed to achieve that growth together with very strong partnerships with some of the world's largest charterers and miners, and I will explain that in the following slide. So we continue to maintain 100% full time charter coverage, but at the same time, given the nature of our charter parties, we are able to capture a very significant upside as far as the market is concerned because we are index linked. At the same time, we have the ability to convert floating to fixed rate for our charters, and that gives, in certain situations, very strong visibility of cash flows for our shareholders. Moving on to the shareholders right now, as I mentioned before, our top priority is to deliver the best possible shareholder returns. So since the full implementation of our dividend policy, we have distributed a very significant amount of dividends to our shareholders. Just in 2025, we have distributed approximately 43 cents per share, and since 2022, we have distributed $2.64 per share, or about $51.2 million in total. And we have repurchased shares and warrants and all that, approximately $20 million in the last 5 years. So total shareholder return since Q4 of 2021 is close to $100 million. So a company with less than $300 million of market cap to have distributed close to $100 million of shareholder returns and cash dividends in the past few years, that is extremely, extremely important. Also, capital structure and financial efficiency. We maintain moderate leverage levels. Since 2021, we have reduced our leverage to approximately 50%. So we like this number. We like to be around the 50% level as far as the net loan to value is concerned. Something that I forgot to mention before is that excluding the dividends, this company has delivered 5 years of consistent profitability. So not just 17 consecutive quarterly earnings and dividends, but also 5 years of consistent profitability for our investors. Moving on to the next slide. A few words about our commercial agreements. As you can see on the right-hand side of this slide, we do business with some of the world's largest operators, miners, and some amazing big names in the dry bulk space as far as raw materials are concerned. We transport raw materials such as iron ore, coal, and bauxite that are fundamental raw materials for the infrastructure growth of the world. So this is how we have developed the company so far. We have been in partnership with all these very high quality names. And as you can see on the graph on the top right-hand side of this slide, you will see that in most cases, especially when the market has been dropping, Seanergy has consistently overperformed the BCI. And that is because we tend to convert with a very dynamic strategy. We tend to convert the floating rate into fixed rates whenever we feel that is appropriate. And in that case, we deliver superior returns to our investors. And that's pretty much evident, as you can see in the recent quarterly financial statements of the company. Seanergy has been among the 2 or 3 top reporting companies as far as time charter equivalent and, of course, earnings per share are concerned. So our strong strategy here is to be among the top companies as far as time charter equivalent, and at the same time deliver the highest possible earnings per share and dividends per share for our investors. Moving on to the next slide, slide number 11. I keep repeating that our top priority is to deliver and prioritize shareholder returns. Since Q4 of 2021, we estimate our total shareholder returns to be in the region of around $96.4 million. That's almost $100 million. And in relative terms, for a company that has market cap below $300 million, to have distributed or delivered shareholder returns of approximately $100 million, that shows a lot for our commitment to delivering this kind of returns to our investors. I will now pass the floor to my colleague, Stavros Gyftakis, our CFO, and Stavros will discuss a little bit about our financing arrangements, which is coming into the next slide, slide number 12. So, Stavros, please go ahead.
Thank you very much, Stamatis. Good morning also from my side. On the next slide, over the past few years, we have been focusing on optimizing the capital structure, one of the key pillars that Stamatis mentioned before, and reducing leverage. We have achieved that through the refinancing of legacy facilities, which happened actually in two stages. It's a dynamic process, so the ship financing market changes and we adapt. So firstly in 21, 22, and most recently in 24, 25, we have consistently managed to reduce our financing costs. At the same time, all the newly introduced facilities have very steep amortization schedule, which allow the gradual deleveraging of the company. And at the same time, we have diversified our financing sources across bank debt and leasing to ensure the flexibility that we need to pursue our corporate strategy. On the next slide, some key financials. I mean, we like to focus on some key metrics and ratios that drive value in shipping, as is fleet utilization, whereby based on our commercial strategy, we have consistently managed to be on the very high side. Time charter equivalent, as Stamatis mentioned before, on a fleet-wide basis, we have achieved one of the strongest time charter equivalents across the dry bulk listed peers, and this is consistent. EBITDA and adjusted EBITDA in terms of exhibiting cash flow generation and cash flow resilience. We have tried basically to ensure that we generate positive cash flows across every value environment, and this is also reflected in the consistent 5-year profitability of the company that was mentioned before by Stamatis. Very briefly, moving to the next slide. So what we have managed to demonstrate basically over the last 5 years, this is a reflection of our corporate strategy, consistent strong EBITDA generation, improving leverage ratios and matrices across the board over the last 5 years. I mean, the comparison with 2020 is staggering, and also reducing financing costs. Strategically, this has been achieved, as Stamatis very well said before, on the basis of very selective acquisitions, counter-cyclical acquisitions, reflecting the lowest book value per deadweight amongst our peers, a very disciplined financing and balance sheet strategy, and a very balanced commercial strategy at the same time. This concludes basically the overview of the financial performance, and Stamatis, maybe you want to talk about the market before we conclude.
Thank you. If we can move, please, to the market fundamental slide. Thank you very much. What I want to say here is that we have seen in 2025 a record Brazilian iron ore exports, 7.1% growth compared to 2024, and 2026 to date we are at the same levels, if not a little bit better. Bauxite has always been very strong the last few years. So it's been growing consistently over and over again, and we expect bauxite to remain a very strong driver of the Capesize demand. It appears that the outlook from the major miners in 2026, it appears to be very strong. We do not anticipate any reductions as far as transport volumes are concerned. And also the ton mile with the new Simandou mine in West Africa is expected to grow. So that by itself produces a very strong demand as far as iron ore. A wild card in demand, which is the recent geopolitical developments, is the fact that since natural gas appears to be in certain constraints in the Far East, which is primarily the place of coal-fired production, energy production, we expect to see, and we have started to see, a lot of power plants converting into coal, back into coal. And that, in our opinion, I don't know if that's going to be the full extent of the analyst estimate of about 150 million tons a year, but if it's anywhere between 100 and 200 million tons of additional coal demand for the reactivation of coal-fired power plants, I think that's going to be a tremendous increase of demand factors for our sector, the Capesize sector. Moving on to the next slide, slide number 18. Why I was repeating before that the deliveries in 2027 appear to be a very, very strong, advantage for us is the fact that currently the Capesize and Newcastlemax segment has the lowest order book of the last 20 years. So right now we have the lowest level of new buildings versus existing fleet that we have not seen for about since 2005, 2006. At the same time, which is extremely important, is that the Cape fleet is growing older. Within 2026, as I mentioned here, about 40% of the existing fleet will surpass 15 years of age. As you can imagine, this is a very old fleet. This is an aging fleet. Our fleet is pretty much close to this average age, and there is very limited shipyard capacity to start delivering vessels in the next few years for the required fleet renewal. And the reason for that, the most important reason for that, is that the shipyards around the world, especially in China, Japan, and South Korea, are tied up with other vessel types, such as containers, LNGs, and tankers that have been enjoying some of the best times in history. So there's no free slot to build these big ships like Capesize and Newcastlemaxes. Very limited order book, far, far below the amount of vessels that will start exiting the market starting in 27 and 28. So we expect to see a very, very strong tightening of vessel supply in the next few years. And we do not really see how that can change because it's a pretty much given capacity altogether. So yes, demand fundamentals are strong and positive, but the supply fundamentals, moreover, supply fundamentals for our Capesize sector are in what we believe to be a very strong historical time. So this is not going to change, and we believe that the demand and supply fundamentals will be very favorable for our business. On that note, I would like to end the presentation now, and we are open to take any questions you may have. So, Nicholas, if you can coordinate questions, I'll be more than happy to address them.
Stamatis and Stavros, thank you very, very much for a very thorough and well put together presentation. I would like to remind our attendees that you're welcome to submit your questions through the Q&A button at the bottom of your screen, and your questions will be replied as they come in. I already have a few of them, so allow me to start. If you were to summarize it, can you give us a statement on what are the main elements that differentiate Seanergy strategy and positioning versus your peers?
Well, thanks. As I mentioned in the beginning of the presentation, Seanergy, first of all, is an independent company. We do not have any, let's say, private equities or family relationships or any side businesses whatsoever. So we have full alignment of our interests with all the shareholders, and that full alignment is pretty much evident in our results. Of course, it's also the concentration. We are focused. I think it's just us and another competitor company that we are fully focused on KPIs and Newcastlemaxes, and that by itself will deliver significant returns in the next few years because the fundamentals of the KPIs and the Newcastlemax segment are well superior than other asset classes. So these are the two, in my opinion, differentiating factors, and that's how we will continue delivering strong results to our shareholders.
Thank you. Now, a question that came through, which is a typical question when you're dealing with publicly listed companies, is capital allocation. And how do you prioritize between fleet growth, deleveraging, and shareholder returns, especially given at this point of the cycle?
That's a great question. First of all, I will start by saying that we have already in place a $385 million vessel renewal program, which will deliver 5 ships in the next few years. Most importantly, the majority in 2027. As we have done in the previous 5 years, where we have invested close to $500 million in new vessel acquisitions, we have always prioritized shareholder returns. So no matter the investment program of the company, as we have shown in the previous years, we will continue to deliver very strong returns to our shareholders. So the last 5 years, we invested about $500 million in new vessel acquisitions, growing our fleet from 10 ships to 20, almost doubling our fleet. And at the same time, we have paid and returned approximately, we have paid around $64 million in cash dividends, and the total shareholder returns have been close to $100 million. So for us, delivering shareholder value and returning capital to our shareholders is our top priority.
And also, Stamatis, if I may add, I think our dividend formula is a good proxy, Nicholas. I mean, 50% of the free cash flow goes out to dividends, no matter what. That's a stated formula and policy of the company. And then the rest, 50%, remains with the company to support our CapEx requirements. And that's after debt service, which ensures deleveraging. So basically, it's baked in our dividend formula.
Stavros, I think that kind of puts us in the next question you asked to some extent. You've returned significant capital. How sustainable is your dividend policy?
Well, if you...
I mean, it's sustainable in the sense that, first of all, it's based on free cash flow. I mean, we have ensured, as Stamatis very well said before during the presentation, that the company has break-evens that can be supported by almost any market environment and ensure some cash flow generation. At the same time, the strong cash position also on the balance sheet. So if we have a weaker quarter, the board can always exercise some discretion on the dividend payments. And basically, our track record has shown that we prioritize shareholder returns no matter where the market lies.
Thank you. Now, another question that just came in. Can you please talk about your vessel employment strategy? Are you exposed primarily to the spot market? Do you prefer a mix of spot and term? And how is your strategy currently, given the overall market conditions?
Well, that's a great question. All of our fleet is basically on time charter. So all of our vessels operate through period employment with some of the world's largest charters. Now, the thing is that no matter the time charter basis, the period agreements, let's say, which cover a certain period of time, we also have spot exposure because all of our charters are index linked, which means that we earn the average rate of the Baltic Capesize index on a daily basis. But thanks to a very innovative term in our agreements, we are able to convert unilaterally most or all of our time charters from floating to fixed. So from time to time, we choose when the right period of the cycle is in order for us to convert from floating to fixed. And when that happens, we have a certain amount of our vessel days operating under a fixed rate. Right now, for the remainder of the year, our fleet is covered by approximately 50% at a rate which is 29,000.
Yes,
29,300. Yes. So 50% of our fleet for the remainder of 2026 is covered at a rate which is well above our break-even in a very profitable rate, which is 29,300. So the answer is very simple. All of our ships are time charter. Initially, they are index linked, which means they are making the spot rate, but we have the ability to convert from floating to fixed, and we choose from time to time to have 30 to 50% of our fleet covered through conversions of floating to fixed.
Thank you. Stamatis, another question that came through. You have been particularly active when it comes to AI, to a number of projects that you're involved with in terms of operations and so on. Can you elaborate on your strategy on those fronts and the impact that they have on the company as a whole?
Well, thank you, Nicola. That's a great question. We have right now two AI investments in Seanergy. One is associated with vessel technical management that we believe it's going to produce breakthrough developments in the next few years, as it will help assist the quality of technical management services that we perform on our ships, which is already pretty high. It's just that it will help standardize and cut a lot of time from our technical superintendents monitoring, performing, and maintaining our vessels. So one investment is called Ask Chief, which is a great AI as far as technical management is concerned. And the second AI investment that we have as a company is called Signal Fusion, which is a psychological assessment, voice psychological assessment of our seafarers through a very advanced AI model that has certain elements right now, and I cannot say too much about it, that has been negotiated with the US Army for psychological assessment. So crew psychological assessment through voice technology, AI, and Ask Chief, that's the Signal Fusion, and Ask Chief for technical management are two of our key AI investments that the company is participating in.
Thank you. Now we have two questions on geopolitics. But they're kind of similar. How do you see recent geopolitical developments, particularly in the Middle East, impacting the dry bulk trade flows and Capesize demand? And a question very similar to that is, it seems that the conflict in the Middle East has affected primarily the tanker sector. How do you see the dry bulk fitting in the puzzle?
Well, that's an excellent question and very, very current, if I may say, with all these things going on. And we have different developments on a day-by-day basis. So I don't know whether a month from today, if the replay of this particular webinar will have current information about it. But overall, if this thing continues for a few more weeks or months with the closure of the Hormuz Strait and everything associated with that, then the world may get into certain recessionary mode, which is something that everybody kind of wants to avoid. So let's be optimistic that we will have a certain quick resolution of this crisis, and we will not get into a long-term recessionary mode, which is going to take months and years thereafter to be resolved. As far as the demand is concerned for dry bulk services, as I mentioned in my presentation, we are already seeing a lot of Far Eastern power plants being converted into back into coal, because natural gas for electricity production is very scarce. It has proven to be very scarce. And that is only going to have a snowball effect in the next few weeks, because the more you have petrochemicals, you have energy production, coal will come into play more and more. And we feel that the inventories of coal in certain key certain key consumption areas such as China, India, and even Europe, believe it or not, the inventories of coal, even though we want to avoid saying that we're using coal in Europe, they're very, very low. So there will be a restocking of coal, and that, in our opinion, is going to have a tremendous effect, positive effect on the Capesize segment, because this is going to be long-haul coal, like the one happened in 2022. So this is the only thing I can mention. Let's hope we avoid long-term recessionary effects, and if not, on a long-term basis, a reconstruction of destroyed places and coal in the meantime will be very positive for the Capesize segment.
Stamatis, we had the question exactly on that, but you answered. And I think if I may add my own 5 cents, obviously you talk about limited shipyard capacity, the order book, slow order book growth, and so on. But at the end of the day, unfortunately, this war situation all over the place, there are so many areas that need to be reconstructed when this is over, and at some point of time, hopefully this will be over. So that should create reconstruction demand well beyond coal.
Yes, this is exactly right. And already so far, the world has a very demanding infrastructure needs, trillions of dollars in the Middle East, which I assume they are currently postponed. But at the same time, we see massive infrastructure investments in the US and other places in the world, plus the destroyed areas that will need to be rebuilt in the next few years. And as I mentioned in my presentation, in the slides, the supply of vessels is very, very thin in the next few years. And that's going to create, in our opinion, a very strong supply squeeze, which is not evident right now, but it's going to be shown more and more in the next quarters as it comes.
Thank you. Well, I'd like to thank you very much for being with us today. We had quite a few questions coming through. So I'd like to thank Stamatis and Stavros, and of course, all of the attendees who joined our webinar. I'd like to remind everybody that this will also be available soon for access upon demand on Capital Link's website at capitallinkwebinars.com and also on Capital Link's YouTube channel. Stamatis and Stavros, thank you, and thank you to everybody for being with us. And that concludes our presentation for today.
Thank you very much.
Thank you, Nicola.